February 26, 2022. A cold winter morning that seemed ordinary for most of the world, but inside the rooms of global power, something massive was taking shape. Only 48 hours had passed since Russia launched its full-scale invasion of Ukraine, yet the shockwaves of that decision had already reached every major capital: Washington, Brussels, London, Berlin, Paris. Behind closed doors, phones were ringing non-stop. Diplomats, finance ministers, and central bank officials were locked in urgent, high-pressure meetings. The world was watching a war unfold on the ground, but an even bigger war was preparing to unfold in the financial world, silent, invisible, but far more dangerous. That morning, the United States and the European Union made an announcement that would shake the entire global financial system. They declared that Russia would be cut off from SWIFT, the Society for Worldwide Interbank Financial Telecommunication, the primary system that allows banks around the world to communicate and process international payments. For most people, SWIFT was an unknown word. It wasn't something ordinary people thought about. But for businesses, banks, and nations, SWIFT was everything. It connected over 11,000 banks in more than 200 countries, enabling trillions of dollars to move safely across borders every single day. Shutting a country out of SWIFT was like shutting off its ability to breathe financially. As the news spread, markets froze for a moment. Analysts, traders, and bankers who had been dealing with geopolitical tension for years suddenly realized they had entered completely new territory. Cutting off a major G20 economy and a nuclear-armed nation from the global financial bloodstream was unprecedented. Inside Russia, the ripple effects were immediate. Banks struggled to communicate with foreign partners. Importers and exporters rushed to find alternate methods to make payments. Ordinary citizens lined up at ATMs, worried their savings might disappear or lose value overnight. Images appeared of long queues outside banks in Moscow and St. Petersburg. People were confused. They didn't understand the technical side of SWIFT, but they understood fear. Fear of losing money, fear of instability, fear of what might come next. Internationally, governments tried to measure the consequences. Some supported the decision completely, seeing it as a strong message against Russia's actions. Others were nervous. Deep inside, many countries realized something far bigger was happening, something that might reshape the future of global finance. Because this wasn't just a punishment for Russia, this was a demonstration of power, a reminder that the financial world was not neutral, and that the West controlled the overwhelming majority of its infrastructure. In Beijing, policymakers watched with narrowed eyes. They had always known that the global financial system was dominated by Western influence, but this move showed just how quickly that influence could be weaponized. China's economy was deeply linked with global trade. Could they ever face something similar? In New Delhi, officials began internal discussions. India was officially neutral, trading with both the West and Russia. But this moment made them think, if one day, for political reasons, India faced a similar situation, what options would they have? Were they too dependent on Western systems? The Middle East, Saudi Arabia, UAE, Qatar, also reacted silently. Their economies relied heavily on energy exports, most of which were priced in US dollars and cleared through Western financial systems. If the global financial structure could be used like a tool or even a weapon, then wasn't it smart to prepare alternatives? Africa, often overlooked in global financial conversations, also paid attention. Many African nations had suffered from sanctions or currency restrictions in the past. They understood firsthand how vulnerable financial dependence could make a country. Within hours, analysts all over the world began writing the same thing. This decision will have long-term consequences far beyond Russia. Because the message was clear. The West had the ability to financially isolate any country it chose, and whether justified or not, this realization scared governments everywhere. Meanwhile, crises began building in Russia's financial markets. The ruble started falling sharply. Investors panicked. International companies questioned whether they could continue doing business in Russia at all. A wave of uncertainty rolled across global boards and trading desks. But something else was happening too. Something quieter, something deeper. Countries began studying how dependent they were on Western financial systems. Many did not like what they saw. If the international financial arteries could be shut for Russia, they could be shut for others. The world suddenly understood that the global monetary order was not balanced, it was centralized, and that centralization came with risks. This single action revealed a hard truth. Financial stability could be disrupted instantly by geopolitical decisions. No matter how powerful a country was, no matter how large its economy was, if its access to the global payment system could be switched off, then it was never truly independent. China did not wait. High-ranking officials immediately held strategic meetings on how to accelerate their own cross-border payment system. Chinese economists went on national television, warning citizens that reliance on Western financial networks could be dangerous. Russia, too, realized it had no choice. It needed its own systems, its own routes, its own ways to carry out international trade without depending on Western institutions. European media and global platforms debated whether this would create new financial alliances. Economists began predicting the rise of multiple competing systems rather than one dominant global system. For decades, the financial world had been stable, predictable, unified under a Western-led structure. But now, on February 26, 2022, that certainty disappeared. It became clear that the global financial system was entering a new chapter, one full of competition, tension, and rapid transformation. The shockwave that began with a single announcement continued to spread across continents. Banks, governments, and corporations knew they had entered a new era, one where the balance of financial power was no longer guaranteed. And as the world took its first steps into this uncertain future, a quiet question echoed across capitals. If this can happen to Russia today, which country could face it tomorrow? The announcement that Russia had been cut off from SWIFT sent a shockwave through the global financial world, but what followed afterward was even more important. Quietly, strategically, and without dramatic headlines, countries began to rethink their entire financial dependencies. A new global race had begun, not on the battlefield, not in technology, but in financial independence. For decades, the world had operated under one primary system. The U.S. dollar dominated international trade. Western banks handled most of the clearing. SWIFT handled almost all international communication between banks. And for most countries, this setup felt stable and safe. But February 2022 changed everything. Suddenly, governments realized that being part of a unified global system had a hidden weakness. If someone else controls the system, they also control your access. This thought alone triggered one of the biggest financial transformations of the century. China reacted faster than any other nation. Even before the SWIFT decision, Beijing had spent years quietly building an alternative, the CIPS system, cross-border interbank payment system. But after Russia was removed from SWIFT, China accelerated its development. Inside Beijing's financial ministry, long meetings were held. Advisors presented charts showing how deeply China depended on Western payment systems. They explained how sanctions could one day impact China's global trade, not because China did something wrong, but simply because geopolitical tensions might rise. China's leadership agreed on one thing: the country must be prepared for every scenario. CIPS began expanding rapidly. More banks joined, more countries partnered. China encouraged its major trading partners, especially in Asia and Africa, to try settling some transactions through CIPS. It was not meant to replace SWIFT overnight, but it was meant to reduce risk. China also began promoting the idea of using currencies other than the dollar for international trade. Yuan-based transactions increased slowly but steadily. Each small step gave Beijing more confidence that they were no longer financially helpless. Russia had no time to waste. After the SWIFT ban, the Kremlin pushed forward its own system, SPFS, the Russian Financial Messaging System. Until 2022, SPFS was small and rarely used, a backup plan that existed only in case of emergency. Now it was the emergency. Banks inside Russia began connecting to SPFS immediately. Then, Russia started asking its allies, especially countries that still traded with Moscow, to test the system. Some countries resisted at first, worried about backlash from the West, but others were willing to experiment. Every transaction done outside SWIFT, even a small one, felt like a victory for Russia. Inside Moscow, officials said repeatedly, "We must never again depend on a system we do not control." This new mindset changed everything about Russia's financial strategy. India did not take sides publicly. The country traded with Russia, with China, and with the West. But the SWIFT incident made Indian policymakers think deeply. India imported massive amounts of oil. What if someday payment channels got blocked? What if sanctions were used as pressure tools? What if global systems became unstable due to political changes? India began testing limited rupee-based trade with several countries, including Russia. It wasn't perfect, it wasn't fast, but it was a step toward reducing dependency on external systems. Inside New Delhi, senior officials discussed joining or supporting multiple networks, SWIFT, CIPS, and even new regional systems. India wanted flexibility, not dominance. The goal was simple. If one door closes, we should always have another. Meanwhile, in the Gulf region, Saudi Arabia, UAE, Qatar, and others, a new financial conversation was taking place. These countries were among the world's biggest exporters of oil and gas. Their energy trade relied heavily on Western banks and the US dollar. But watching Russia's predicament made them question their own vulnerability. Saudi economic advisors argued that the kingdom should explore new payment routes. UAE officials suggested diversifying financial partners. Some Gulf nations quietly began negotiating with China and India about settling part of their energy trade in local currencies. These were early discussions, but significant. The Middle East had always been financially aligned with the West. Now, for the first time, they were considering a multi-directional approach. Africa rarely gets attention in global financial narratives, but it is one of the continents most affected by currency instability and sanctions. African economists saw a chance to reduce their own dependence on Western-controlled systems. South Africa, Nigeria, Kenya all began exploring alternative payment networks and digital financial systems that could connect them more directly to Asia and the Middle East. For Africa, this wasn't about politics. It was about survival, stability, and having choices. Even though the public conversation calmed down, inside governments and central banks, an enormous shift was happening. Countries were signing currency swap agreements. Banks were experimenting with new cross-border systems. Governments were reducing their dollar reserves slowly. New financial alliances were forming quietly. This was not a loud, dramatic revolution. It was silent, technical, and slow, but powerful. Every step countries took away from SWIFT created a tiny crack in the global financial order that had stood strong for over 50 years. For decades, the US dollar had been the king of world currencies, used in energy trade, global banking, and reserves. But now, not because of war, but because of financial fear, countries were exploring alternatives. They weren't abandoning the dollar. They were simply reducing the risk of dependency. Whether it was yuan, rupees, dirhams, or euros, countries wanted multiple options, and that desire alone started shifting the global balance. By the end of 2022, something new was forming, a multipolar financial world. Not one dominant system, but many. Not one global payment route, but several. Not one currency controlling everything, but a mix of many. Global finance was becoming like global politics, divided, competitive, and unpredictable. Banks began preparing for a future where they might have to operate on several systems simultaneously. Corporations hired specialists to manage payments in multiple currencies. Digital payment platforms expanded faster than ever. Everyone was adjusting, quietly, carefully, but decisively. The SWIFT decision had not simply punished Russia. It had unlocked a long-suppressed global conversation. Should any country have this much financial power over the world? The answer, for many nations, was no. And so, without wars, without speeches, without headlines, a transformation began, a shift that would define the next decade of global economics. A future where financial networks would compete, a future where countries would rely less on any single system, a future where the world's money flows would never again be controlled by just one side.